Hello, everyone, and welcome to our fourth webinar in a series of 5 presentations by Jim Dalton, Run for the Roses, Navigating Year-End Trading. It is December 14th, 2015. We'll go for about an hour. And, oh my gosh, okay. Oh, that's bad. That's pretty bad. Okay, let's start over here. Forgot to do that. All right, everyone, thank you. Let me shut this off. Okay. I beg your pardon, everyone. Please pardon me. Okay, so it is 9:02 a.m. Eastern. Thank you, everyone, for being here. Great to have you all. We will review the 2 last week. We'll review this morning and what Jim sees for today, for the week, and as it comes in context with the end of the year. And we can see Jim's screen here. If you didn't see the screen share at the beginning, please go to jdaltontrading.com to download the 2 reports for today. They are available under Resources, Webinars, Upcoming Webinars. Okay, so any issue with that, let me know. And with that, I am going to hand it over to Jim Dalton. Okay, hi, Jim.
Thank you, Julia. Julia's been a little bit busy. We've had a tremendous response to the recent program that really kicks off, the first part of it kicks off today because anybody that's registered for the program starts getting the 2 daily reports, but she's just swamped. But Julia, thank you for holding up the way you have. I'm glad you're in a separate location because we won't know that you haven't had time to shower this morning.
Funny. 5:25 wake-up call, and I don't have time. Scary. Okay.
What we're looking at to begin with is a monthly chart, monthly bar chart of the S&P 500. You have this all on the reports that you download. But you'll see back in 2014, the market was trending higher, and then it made a very sharp break. When this happens, most people just say it's an anomaly, everything's fine, and let's go back to what the market is doing. Very often, that is the first sign that the market is getting very heavy or getting too long. Attitudes don't change, people don't change quickly. Change is a process. A process takes time. What you're looking at here is what is called the balancing process from a very long-term perspective. Keep in mind, everything we talk about in the long time frame is equally applicable to the intermediate and the day time frame trades, even when you look at an individual day time frame profile. These concepts are the same across all time frames. The one we're looking at here was the first initial break in 2014. The market then does rally to new highs. We then had a break in 2015, and you notice that break came close to, well, it tested, it didn't take out the 2014 low. But now you start to see a more fully developing balance or trading range on a longer term perspective. Once again, everybody thinks this is a great buying opportunity, and what we find is usually the first break to test a major reference is rejected, and it's sometime in an 80, 90 plus percentile. Now we get the rally, and the market one time frames higher. One time framing means that this low did not take out this low did not take out this low, etc. And we one time frame higher for the next 3 months. The current month stopped one time framing higher. The cessation of one time framing higher doesn't necessarily mean a higher magnitude of change is underway. However, it certainly alerts you to the potential that change is underway. There's that difference between it's actually underway or it's just an alert that the market is in a fairly close to a go, no-go level. So that's where we are. And the reason over the weekend we used a 2008 reference, which it's, don't try and be exact on it, but it's basically right up, you'll see the 2008 level. What I'm looking at right now is a ability to stay above that level still keeps the current market intact. Breaking down below that level and finding some acceptance and acceleration below the 2008 level then starts to target the potential to come down to the low made in 2014. So I just want you to get a feel of where we are from a top-down perspective. There's no real major change going on yet when you look at price, but the potential for that change has greatly increased. So right now, we did stop one time framing. We're going to see what happens as the market goes, as the market trades throughout this week. Okay, let me go over and I want to take a look at what happened on Friday. Friday was the day that the market broke and it took out that level that we were talking about. There's the 2008 level. If you're reading the report, if you've already read or reviewed the report, in the report we cautioned that Friday's market was very short. My guess is that the majority of traders expected Sunday's market to open substantially lower. I don't know if that's true or not, but I would guess that a lot of people did, because what they saw on Friday was they saw price continue to sell off. The market traders were selling every small rally on Friday. The report that we provided over the weekend cautioned that the market might have been dangerously short at the end of Friday's trade, and that there were several things in that that led me to believe that. First of all was just through observation of watching the way the market traded on Friday. The little rallies were going up to mechanical levels. Early on, a mechanical level had been exactly half back. You'll see even in the morning, the early morning rally was just a few ticks short of a prior low. And that's just one indication. When it goes to a mechanical level like that, very often it's short-term emotional trading rather than long-term trading. Doesn't have to be, but it is an alert. Now, as the market traded lower on Friday, the market would rally back, and sometimes it would rally back to what was exactly half back at the time or just a few ticks above it or below it. Longer-term money has no idea where half back is. Half back is a reference that is used by day and short-term traders. What we're always trying to figure out is who is driving the market. And in this case, it looked to me like being driven lower was by short-term day and short-term emotional money. When we review structure, we will see that the point of control is up here at the 2012 level. If I had longer-term money, more serious money that has a more lasting impact in the market, the odds are that the point of control, which is also the fairest price at which business is being conducted, would have continued to migrate lower on Friday. It didn't do that. It remained up here, which indicated to me that traders were selling short in the hole. Short in the hole, they were selling below the fairest price of the day. Short in the hole just means traders are selling at prices below value. Sometimes that works out, sometimes it doesn't. But certainly when you're selling prices below value, you are adding substantial risk to your portfolio. So now you saw the market open last night, and it immediately, there's the kind of opening split up. Opened last night, and the market immediately rallied almost up, to the where it was 4 wide up here. Again, a very mechanical level near the top. So as we are 20 minutes or so from the opening this morning, we have inventory that is probably short relative to Friday, but we have overnight inventory that is long. We know that about 65% of the time there is a counteraction to overnight inventory. So the counteraction is overnight inventory is long. We know about 65% of the time counteraction would be that the market would sell off to adjust that inventory. But then we have to go another step further, and another step further is let's look at underlying circumstances. And the underlying circumstances here was that inventory was likely short as the market settled on Friday. So now the market being long overnight is offset a little bit by Friday's action. So the odds aren't quite as high that we will sell off relative to overnight inventory. Overnight inventory rallied. Then we saw it came all the way back down, extended on the downside not too long ago. Now we're back up. There's the halfway point of overnight inventory, the white line right there. And now we're just about centered relative to overnight inventory. So as we come close, as we come approaching the open, where overnight inventory is long, daytime inventory is short from Friday, and we've got crude oil. It was, I don't know where it is right now, a little while ago, crude oil was trading under $35. And this market is still very emotional and very much susceptible to these short-term influences in the market. And that makes it a very difficult emotional market to trade. All right, Julia, let me stop there and see what kind of questions we can deal with here.
Okay, great. Thank you, Jim. Does Jim factor in the looming interest rate rise in his analysis, or does he strictly go by market-generated information? It seems like the market has gone down each month. Interest rates were expected to rise going back to August.
There's going to be a new piece posted to our website sometime today, and it was written by a longtime acquaintance of mine, Brett Steenbarger. Brett, who I'm guessing that most of you know, sent me a 40-page response to the first book, Mind Over Markets. And one of the things that he talked in the piece that he just gave us that allows us to post to our website is the fact that we are not looking at this top-down economic numbers or anticipating or playing about when the next Fed rate hike is going to be or not going to be. We are simply taking the market and breaking it down and looking at where the buying and selling is coming into the market. And so no, we don't look at or consider the Fed action. We know it's out there. I mean, everybody, it's all they drive you nuts talking about it. The problem, if you go focusing on those type of things, is you're almost assured that you will get cognitive dissonance, making it very, very difficult for you to trade correctly. The majority of our clients are short-term traders. Short-term trading has very little to do with these economic events. Short-term trading has an awful lot to do with trends, and right now we're not in a trend. We have a short-term trend to the downside, but we're at the lower level of that trend. Where we are at the 2008 level is probably a go, no-go level. Trading below it, we probably morph into an intermediate leg to the downside. Stay above it, we remain within the trading range. But so much of the trading our clients are involved with has to do with inventory imbalances. So for example, Friday, it looked to me like the market was short by day and short-term time frame traders. What did we see last night? We saw the market go almost back up to the upper extent of Friday, probably somewhat related to inventory from Friday. So inventory is very important, just as we talk about inventory from overnight trading. So no, we don't factor those things in. And what is also very important, and people that are good traders, have been with me for some period of time, really endorse what I'm about to say, and that is, do not look or read economic reports. Know what time those reports are due out, because they will add short-term volatility to the market. But if you know the numbers, most people, I would guess that probably 98% of the people can't resist go looking at the number or listening to what it was. And for example, the last time the jobs report came out, the jobs report was very positive. I can't remember what the exact numbers were, but the market did opposite of what you thought it would have done relative to the numbers. Looking at those numbers really increases the odds you get cognitive dissonance. Know what time the report is coming. Look and see how the market itself reacts to that number. And like I say, people that have been around for a while will endorse that wholeheartedly. And I'm talking about some very professional traders. Not everybody, but some very professional traders that have been with us a long time say that's absolutely correct. Okay, next question.
Okay, fabulous. Thanks, Jim. Do you see any completion to the long-term auction made this summer?
No. One of the things that I have commented on, there is no real, there is excess, but there's no real meaningful excess to the longer term auction. I was asked that question by an institution yesterday that have heard me speak about this before. What I have said is, when you have an auction that has either no or very limited excess is, just think about an auction, put excess in perspective. If you go to an auction and the auction goes up to the last bidder bid, if it was a good solid auction, well run, price ought to drop quickly away once the auction is completed. Price did not drop quickly away once we made the new high a few months ago. So when you don't have real solid completion to an auction, which is I think where we are right now, what you have a tendency, you can get liquidation. And I've seen liquidation go up to 15%. However, then you get a fairly fast recovery and market goes to new highs. When you have good, meaningful excess on the highs, it is not uncommon for the market not to come back there for some years. So I do not see a healthy completion to the current auction. I've been saying that for months, and I think that's part of the reason the markets never really come apart. We're not that far off of this right now. Another question I was asked yesterday, and I'm asked all the time, and that is, did I see long-term money selling in this market recently or on Friday? And my answer is no. I haven't seen longer-term or institutional money on either side of this market, to any great extent for a considerable period of time. If you put yourself in the mind of an institutional investor, look at the monthly bar. We're not very far off of the highs. A lot of times, institutional money, they just look at this as just noise that's going on in the market. Very often, what you will find is the real selling from institutions, or longer-term money, doesn't come in a lot of times until the market is substantially lower. They're like the rest of us. Sometimes they're very complacent, but then when they throw in the towel, then it can get really ugly. For example, if you go back, think prior Lehman Brothers, many years ago, 8, 9 years ago, the real break came, the market had been going down, which set the stage for what finally happened. But the real volume came in on the sell side after Lehman Brothers. The long-term money didn't bail out till the market was down substantially. And right now, I think there's a lot of long-term money out there. They've adjusted positions. They think by adjusting positions, they've taken, more conservative things to weather the storm. But what happens when markets really get bad, they tend to correlate together. So a lot of times, before you get a correction over, there is no safe port in the storm a lot of times other than cash. So right now, I think we're still in a trading environment, but it is important to me right now that this, for the right current, this 2008 level is very important to me. Then if we get below that, we can get some more of the downside and we stay within this trading range. The long-term markets, remember, they go bull, balance, revert back to bull, bull, balance, reverse to bear. So we're in that process. Okay, other questions?
Yes, thank you, Jim. Why is 2008 more important than the 2014 50 level, which got broken on Friday and was the November low?
When I looked at the charts, that's the number that appeared to me to be important, and you'll see it right along. Right along this level, there's a low in there. You could pick a lot of them, but when I looked at the charts and I looked at the profiles, the last rally came from this level. When I look at the weeklies, that appears to be a relatively important level. And depending on what chart you use, the numbers will be different numbers. Come up this, the low last month, you're right, was 2014. I give it a little, just a little, looking at the profiles, just a little bit of room. We're not talking about exactness in here. So I'm not going to quibble with the numbers. When I looked at this and I looked at the weeklies, the 2008 level appeared to be a relevant number. And what was interesting, I was talking to Julia last night, the early overnight rally, the first leg of the overnight rally.
Can you make that a little larger, Jim, just so, thanks. We can see.
The first stop at the overnight rally, the first high, was 2007.75. So I'm guessing, and I look, this number right here is 2007.75. So I'm guessing at that point that I'm not the only one looking at the 2008 number. Notice this, so it rallied up just a quarter tick short of it. It came down just a couple ticks below it, then it rallied again. My guess is that's the number, but it's not a science and it doesn't have to be exact. Okay? But good question, fair question.
Great, thanks, Jim. Can you comment on the bond market, regarding the junk bond market issue that's come up? And we have another gentleman who is asking, why do you think bonds are going higher if rates are supposed to go up? Should bond futures be heading down if rates are going up? Just to talk about the bond market, if you have any comments for them.
But there's, again, trying to make logical assumptions and trade based on that view is very destructive many times for short-term traders. Remember, so much is inventory related and related to the quality of the issues. So you can get, you've got a disaster going on in the shorter-term credit markets, and all the things that all the people bought the high-yield junk bond stuff in anticipation of getting rates, which I think is one of the problems with the Fed holding rates down so long. I'm 75 years old, and I can promise you that I have been far more cautious in what I had do with my money and investments and things I do, based on the fact that I'm not getting any return on my longer term money. Now, I I didn't go chase the higher yields. It's just not my nature. I've held a lot of cash simply because cash that would normally be in fixed income, the yield wasn't worth it to me. But there were a lot of people that went out and chased that money. One of the big junk bond, guys was out here 3 months ago still supporting what they did. And of course now they're in liquidation. So what's going on in the junk bond market is you've got a lot of fear, you've got a lot of liquidation, and you've got liquidity problems. Now what happens from time to time, you'll get a flight to quality in the 30-year Treasury, 10, 20, 30-year Treasury. So that can happen all the time. A lot of knee-jerk reactions in there. So I would say, again, we come back, instead of looking at economic theory, we look at the markets generated information to say, what is the actual trading going on in the market? Okay, thank you.
Thank you, Jim. Could the weekly excess be triggering this short-term down move? If we could look at a weekly bar there, see what he's referencing.
Yeah, the weekly excess was way back here. What the market did, the market rallied up and failed to take out this high. So you have a trading range. So it went to this is again what we do on a short-term basis. It went to the top of the multi-week range right here. It failed to take it. Now the rotation is back down lower. The low of that distribution is 2008, and that's another reason why I was using that as a reference. And now, so that's 1, 2, 3, 4, 5, 6, 7, 8 weeks. So that's another area right here. This is a trading range. Okay, do you stay above this trading range? Or do you go and get accepted below it? You get accepted below it. I'm now focusing on the gap here, and the high of this upper distribution. I'm sorry, the low, the high of this gap. And this gap would be 1955.25. If we get accepted down here, then I'm focused on the gap. Markets very often go to very visual type of level. So again, it's not this excess. I think it's the failure to go through the excess high that kind of leads to the trading to the downside. But again, looking at this for perspective, this is why I start with monthly, weekly, and daily to get a perspective of what's going on. Okay, we're getting very close to the opening. And so you can see we're just shy of half back in the overnight market. Half back is when I see markets going to half back, that tells me that I've got short-term money in there. So let's review with a minute to go.
Jim, okay, go ahead. You can shut off one of your profiles just so we have more room. But go ahead.
Okay, well, we'll get it off here in a minute.
Yep.
Overnight, Friday inventory was short on Friday. Overnight inventory is long. We're set to open just about halfway, about the center of the overnight inventory. And the overnight highs and lows are going to be relevant to us. They are very important short-term trading vehicles. Okay.
Want to make that a little larger, Jim, too, please?
I will, and let me get rid of some of this other.
Hover over your lower time templates, and you can get rid of that one. Oh no, the other one. Drop it down right there. Thanks. You want to mark the settle, or does that matter? The pit low. Thank you. You shut your time. Yeah, thanks. I'm bossy. Okay.
Again. Okay. So what you see is we're opening within Friday's range. We've already said inventory was short from Friday, probably long from overnight. Market opened, traded off a little bit. There's unchanged. It did not get to unchanged. This is unchanged is a very important day time frame reference. Okay, so we opened, we went lower, we're back through the opening, we're right about unchanged from at the center of the overnight range. Very mechanical. But right now we're getting a little bit of short covering in here. And as you remember, if you looked at we talked about it before, and you looked at the reports, I spent quite a bit of time discussing the inventory conditions at the end of Friday. And so that's why I saw a tremendous amount of risk to the long side, to the short side on Friday. So, but keep in mind, so much of this stuff is off of emotional things, oil. It's not a high confidence market. It's going to be a very difficult market for most people to trade. Okay, you can see we're just watching it. Here's unchanged. Unchanged is always an important day time frame traders reference. Longer term money could care less. Day time frame and short term traders look very carefully on this. And it's sometimes very simple. Above here, above unchanged, guess what? Their machines are green. Below unchanged, everything's red. And it's like seeing a bull. Oh, it's red, or it's green, it's go, it's stop. Okay, so again, we're within Friday's range. So it's a trading environment. Generally, when we open within range, we suggest that you let the market shake out. Don't be in any hurry to trade. This is where, when you open within range, this is where you get the maximum spreads on the bid and the offer, which means anything you buy and sell, it's going to cost you a little bit more. And also, this is where you get the most chop. And this is usually an environment to stay out of. And one of the things that we say so often, if you've got that anxiety, oh, I got to trade this morning, I don't want to miss the best trade of the day. Once you have that, if you get that anxiety, you feel it building up, your chances of making the correct trade are very, very low. You're better off just to walk away, take a breath, because this is where the chop comes from. It's not uncommon for traders. Some traders get very emotional and have done 2 and 3 trades already, and they get chopped up. And remember what we've said so often: you have both emotional capital and you have financial capital. I believe that emotional capital is more important than financial capital. Now, from a perspective, remember, if you go back and you look at what I wrote over the weekend, what I wrote over the weekend is that I thought inventory was short, very short, at the end of Friday. So you're not going to find me early on the short side of this market. Even if it goes down, there's certain trades I will pass on. Let me go for a second on, I went home. We said we'd talk about options a little bit as we go through these intensives. I went home long calls on Friday. I bought calls right on the close, nothing to do with valuation or anything else. I just thought that the risk reward was worth it because of how short I thought the market was. The market was very friendly to me and allowed me to get out of those calls at a very nice price. And the calls, anybody's interested, they were the 2050s, so they were substantially out of the money. They expire this Friday, so they're the ES calls that expire with this expiration. But the market gave me a great chance to get out, as I say, overnight. But I wouldn't take the risk of being long futures in there. I don't know what's going on with oil and all the other craziness in the market. But I knew I wouldn't be short the market because of the way it traded on Friday. If there's anybody that wants to understand more about what I wrote and what we said about the shortness on Friday, it's great to understand it right now, because my guess is a lot of people thought we'd open lower last night. Other questions or comments, Julia?
Yes, do you think the overnight inventory was long from overnight, and the fact that we didn't see the adjustment, really anything substantial to adjust that long overnight inventory to the downside here this morning, do you see that as, showing or indicating to you how short the market is?
Yes. Yeah, as we wrote in the report this morning, and we talked about it earlier, we're always looking for extenuating circumstances. The shorts from Friday are more important than the longs from overnight. Some of the longs from overnight would have been people that were short from Friday and forced to cover. And incidentally, another reason that I use options so much rather than futures, you get an awful lot of movement overnight, and you get stopped if you're carrying stops in the electronic market. So often you get taken out of those stops. Okay, so I think the most powerful thing was you so much more importance of volume on Friday than overnight. Overnight's probably a quarter of it. I don't know I didn't look at exactly, but one of the references up is going to be
The
I don't
point
know
of
what I did.
control.
The point of control is right there at the 2012 level. So right now we're still within Friday's range. When you see a market this thin going up this quickly, that
Meaning
is
this
really,
much range, excuse me.
yeah,
This
this
much
much,
range and this
this
many single prints.
single prints within the previous day's range. Thank you. That's usually an indication of very emotional short covering. You've been short. Oh my God, get me out at any price. So again, a lot of chop. Remember what I said earlier on, when you open within range, generally you're going to get a lot of chop, and it can be psychologically devastating. Okay, other questions, comments?
Yes. How does Jim view high confidence moves in balance, which is what we're dealing with this morning, versus high confidence moves out of balance, which would be like Friday with the gap opening lower?
Well, as a short-term trader, obviously you saw well, if you did see the report from Friday, the gap trading rules were in effect, and the gap trading rules are go with all gaps that aren't filled. Also, we said on Friday, the best trade would be an attempt to fill the gap that failed. And notice on Friday, it was a weak attempt, A, B, there's a third period, the market rallied, and it failed to the gaps way up here. So it didn't even come close, but it even failed to get this to this mechanical level. At that point in time, was the confidence high? No, the confidence was not high. It opened, spent some time, rallied, and then it broke. And again, when I'm talking about what I saw on Friday, I didn't see as high a confidence on the downside as price would have indicated. So price was quite a bit lower. They were selling every rally. But at the same time, the structure and everything else told me it was mostly emotional, not high confidence. So it wasn't high confidence, in my opinion, on Friday. But you do go with the gap, and usually when you have a gap of this magnitude, there's so much distortion in the market that momentum players are automatically selling. There's other people that are caught long, and they are just forced to sell because their inventory is out of balance. So it's they've just reached the levels they're forced out of the market. So it's understanding what's going on, understanding that was probably liquidation rather than longer term selling on Friday. It's very important to continue downside continuation and going forward. So I didn't see it as high confidence, which again triggered to why I didn't want to come in. I didn't want to be short going home. Now, I look today, we're within, anytime you're within the previous day's range, it's probably not high confidence. Had this been high confidence, remember the opening was right here. High confidence, we would have opened, maybe looked lower, and we'd have gone.
A few
Remember,
ticks lower, not
pardon?
that much. Maybe a few
Yeah,
ticks lower, and then boom.
yeah.
Yep.
But here we opened, we went lower, we went higher. It's not high confidence, high emotion. High emotion is different than high confidence. So I do not see high confidence, but mostly when you open within the previous day's range, it's very difficult. I mean, this is a lot of range, up, down. Like I say, these are very easy markets to get chopped up in. I'm very comfortable to have no position on at the current time.
It's a little shy of 10 point. It's a 9-point range around there, I believe.
Yep.
Now, this is a good question. if we get below the 2000 level, obviously we're going to be looking at prior references. Someone's asking, do you look at profile structure way back from, August and September area? How do you handle, destination trades or at least lower references once we break below the 2000? Can you
I'm
help them out
aware
with
of
that?
prior points and controls and things like that, but I'm more tendency to look at prior gaps, prior
On a daily
daily,
bar. You look at
yeah,
daily
on a daily,
bars more. Yep.
yeah, daily bar lows, daily bar trading range lows, weekly lows, um, things that are markets are very visual in the way that they trade. So when a market gets under pressure, so people have a tendency to go to their daily bars and their weekly bars and look for visual references. And those visual references very often become self-fulfilling targets once the market gets within range of them. But I'm aware of prior points of control, very prominent points of control on profiles, and it's not uncommon sometimes to see the market stop or hesitate around those levels. But my primary emphasis is really coming from the daily bars and balance area highs and lows, previous highs and lows, as well as balance area highs and lows. The bigger a balance area high and low is going to have far more significance to me than is a daily high or low.
Right. And you've got to incorporate the longer time frame charts when you're going back that far.
Yes,
And then you can
that's where you
fine
start
tune
with
it when you get close.
Look at this market right now. I'm sorry, Julia. I
No,
just want to
please.
come this market. We said on a day time frame basis, unchanged. Look at this market, a single tick above unchanged. That is considered a weak low. Even if you had single prints here, it's a weak low because it went to one tick within a very identifiable reference. And it bounces from that level. That bounce is probably very short-term money. Longer-term money, if they were in here, they have no idea where unchanged is, and they're not going to go to unchanged. But when I see this is a weak reference. As a short-term trader, a lot of times, if I want to be short, I look at this and I take this bounce.
Once
I'll
it
look at this.
bounces off of it, higher.
Yeah, once you bounce off of this, I'll take that as an opportunity to put out a short if I'm a short-term trader. But remember, if you do that, you have to be very quick. But it is a legitimate, if you're looking to go short, you see that weak low, you sell the first bounce off of that because the odds are so good you're coming back through these weak lows. Okay?
Yep, go ahead.
It came back to exactly unchanged. It's still a weak low. It's still
And
a weak low.
right, it
Okay?
hasn't taken out. And we saw that last week where Jim, I think it was a prior high or something. It was a short-term reference that it bounced. Jim said if you want to get a short out, this is where you do it. So we're seeing it again today. If you want to see that on last week's recording, that concept is talked about a lot.
You just saw this is short-term traders, and we have some very quick short-term traders. I don't know if our friend from Minneapolis is with us or not, but they're good short-term traders. And these are references they use. Now, it's a little trickier. Once you get down below that reference, one tick below it isn't sufficient. But if you get below it a few more ticks, right now it's still a weak low because it's only a tick.
Hang in this short because really the low of the pit low from Friday may be the game if they can get there, correct?
Yeah. But what you don't want to see is you don't want to see it look 3 or 4 ticks below this and then come back through it. Now, for right now, if I did short on that bounce, I'm not getting much follow through below this. If a short-term trader, I would probably say I'm going to take at least part of it off because I didn't really get acceleration down here. But that's a personal choice. Like Julia said, the logical target is Friday's low. But I'm looking to see how much, as a short-term trader, how much confidence do I have at this level?
And also, you see Peter Resnicek, and this is Window Trader software. It's called Window Trader Blue. You look at the volume there. It's very light. The low tick has 84 contracts traded. Obviously, lower prices, at least right now, depending on your time frame. If you're a scalper or where you're at in your time frame in trading style, clearly lower prices were cutting off the volume, which goes back to mind over markets.
which brings up a good point. Remember what I said, and some what you were hearing right here. I said the first bounce of sun, I come down here and I could just feel myself. There wasn't any real pickup as we got down below there. I could just feel myself turning inside, and if I were short, I'd have clicked and I'd have just covered.
Or at
I
least
was
half,
so
yeah. And then once
I
it
could
was above,
I
you
can
get
easily
out
see
all. Yep.
this. It made the weak low, the bounce. I can see myself putting it out. Came back in here and no real follow through. More than likely, I could just feel myself twisting inside to say get out, not be patient. But
Okay.
let me go back to the volume for a second. Julia just mentioned. Again, part of what figured into Friday, and this was triggered when she said, talk about volume. Notice the lower portion of Friday. All the colors are white. And white just means volume is light.
Yep. Pink is
Pardon? Yeah,
medium,
white,
red is
yeah,
high.
high. And notice we got not even medium. That also was a factor. I didn't put all of that in. I mean, you can get overwhelmed. I didn't want to overwhelm people. But that was another factor that I was watching. And this was another factor that made
Cranked
me
into your analysis for being
to
too
go
short.
long in my analysis, but also the decision to go home long calls on Friday. And incidentally, I made money on that decision. It certainly wasn't an overwhelming decision because I'm not sure the risk reward was worth it. As the market rallied, volatility went down, and they took a lot of premium out of the calls. It turned out to be an okay trade because of a magnificent rally, but it wasn't a particularly smart trade. I could have bought them lower as we opened last night. Okay. Other questions?
Could you slide your profiles down and to the right so we can see what's coming up above? Also, Jim, we got a question from Mike. The 2015 rally high from Friday, can you split Friday's profile? So go to market profile, right click on that, yeah. And he's asking, is the 2015 level, which is the rally high, if you want to mark that at the J, is that it? J period high, Jim? 2015, just so traders can see that. Do you find that a relevant reference? Are you using that at all today?
I'm not. That doesn't mean that I shouldn't be. I didn't. It wasn't something I focused on. But one of the things that
rally high. Yep.
when you go through the course as we teach here, one of the things I suggest is do your own market analysis first. Then review what you have done relative to what I did and compare. And what happens is you really start to get advanced. Sometimes you say, oh, Dalton missed this. And that's just great because, I miss things all the time. And just because I don't have it doesn't mean it's not right. But it doesn't mean it's, right or wrong. But it's important that you do your work and you say, okay, I have a better understanding than he does. And this may well be a more important reference. Again, I don't always get it right. Okay, go ahead.
Okay. Let's see, do you look at composite profiles, looking at,
No, I do
many
not.
days, just so people understand that question?
No. Great question. Composite profile, you bring multiple days together to make one big profile. It's one of those things that I thought was a great idea early on when I first learned market profile, and I did it for a period of time. The reason I don't do it now is because the composite profiles rob me of some detail that may be very important to me as a short-term trader. And incidentally, several things I want to comment on here. First of all, there's the number one book that I was recommending just a couple of weeks ago was Nonsense by Jamie Holmes. And Nonsense by Jamie Holmes talks a lot about mental flexibility, how we handle change, and things like that. And it's very pertinent to me, to the self-understanding that is so important as a trader. Just after having made that recommendation, I read Brett Steenbarger's new book, Psychology 2.0. Psychology 2.0 is now my #1 recommended book. And the reason for it is that it's #1. A lot of the same research material that was in Nonsense is also in Brett's book. But Brett takes it much further. When you talk about the self-understanding, he does a beautiful job of melding research. He uses Habit, which is one of the books, one of our top recommended books. Tremendous amount of information from Habit is spilled over to Brett's work. So again, we read a lot of the same material, but also he has made a lot of observations from a lot of the traders that he has coached over the years. His last full-time assignment, he was with Tudor Jones. I think now he's probably only part-time there, and I know he's undertaking shortly here a major assignment with a very large money manager. I don't know who it is, but I know it's a very large money manager. But through the days, his observations about self-understanding are the best I've ever seen. This is not a fast read book. This is not a fast read book, but it is absolutely a must read for traders. And do it slowly. Take the tests. He's got some tests that are in there. Take those tests. Write the answers down, and it really helps you understand yourself in your personal life, non-trading, but also things that make you weak or strong as a trader. It's just a wonderful, wonderful work. Best I've ever seen. Okay, I had a feeling I had something else to say and I got sidetracked. Julia, do you remember what it was?
Haha, very funny.
No, I know.
Oh, really? If you could collapse your profiles there, Jim. Yeah. Okay, and just so we could see, so we know one of the upside targets may be the point of control. If you want to read about that, there's many free articles at our site. We have one, Article 80, you know, how these prominent points of controls are often revisited. And if you look over your overnight profiles versus the pit session, you can see how putting a trade on in the overnight, when the context was correct, it went back just like last night, went up and took out the prominent point of control. Obviously came back down for the pit session, and we almost got there this morning. Okay, Jim, value, do you want to comment? Someone's asking, are you looking at value now?
That's an interesting question. My first answer should be I'm always looking at value, but I'm going to give you an honest answer. I really hadn't started to focus on value yet. I am more focused on what the day time frame structure is going to look like. I'm more focused on the unchanged level. I'm more focused on Friday's low. So no, the answer is my automatic answer should be I'm always looking at value, and that's what I would normally say. I'm giving you an honest answer. I was not always focusing on just yet. I was focusing on do we remain within balance relative to Friday? Do we look below balance and fail? Do we look below balance and accelerate? If I don't look below balance and I don't get down to Friday's low, then the chances are that I'm going to get more, at least short covering throughout the day today. If I get down below that, now I'm at a very important go, no go level. So good question. And I'm glad I gave you at least an honest answer. Not the right answer necessarily. What else we got there, Julia?
I was talking to myself. The books that people are asking for the titles, I typed them in for everyone to see, but sometimes people don't see that for some reason. Trading Psychology 2.0, Brett Steenbarger, #1 book in Jim's opinion right now, and Nonsense by Jamie Holmes. Please check the text part of your GoToWebinar software and you'll see it typed in there. I think Jim uses R.J. O'Brien or TD Ameritrade. It depends. He has several accounts for options really in trading.
Yeah, so. my bigger money is with TD Ameritrade.
or the soft, yes, different
Yeah.
accounts. Okay. Um, let's just, the 2000 level, Jim, the fact that the market went just a couple of ticks below, do you think that's suspect in terms of
Yes, I do.
back?
Yep, great question. It's it's close to unchanged. It's a very mechanical visual level. Yes, I think that's important. I think psychologically, again, what I see this morning, I see a lot of short-term trading. I don't see any real commitment. I don't see any real strength on the buy side. I see a lot of jockeying for position here, but I don't see any real commitment.
Okay.
Incidentally, one of the books, I don't know the author for Habit. How do you pronounce his last name?
Oh gosh, The Power of Habit. You caught me. I can't think of it.
It is
Hold
it
on, I'll
is
just look.
also a very important
Yeah,
read.
really
And
fun.
the reason it's an important read, I mean, the book makes the point that if we have bad habits, we really don't change those habits. What they're trying to do is build a new habit over it. And since this is something I've been talking about for years, even though I didn't express it in the same manner. We used to talk about, more we building new neural networks and all this kind of stuff, what I did years ago. And but it's the same thing. So, I mean, something I've always been on is we get these bad habits, and how do we correct them? Sometimes they're very difficult. We have to build over them. Okay,
Right.
just for a second before we go on, early on, I could feel a short-term trade. I just wanted to cover this, but it was never a good low. It was a very mechanical, weak low because it only went a couple ticks below this. Julia kept pointing out, maybe they're after the Friday's low, and it's very possible that if you're a short-term trader, right early on when you didn't get any follow-through here, that's a cover. As a short-term trader, you're doing multiple trades a day. And then say I forget how far it rallied, then it came back down again. But so much depends on who you are and what your personality is. If you're going to do these short-term trades, your personality has got to be one. If it doesn't work, you're out immediately. If you're one of these people who are going to buy it there and then you're going to hem and haw around, you can't do those trades because these are very volatile, difficult markets. But there's some trades that are good for people that have, really good, fast instincts, and they can turn on a dime and not get married to a trade. You get married to a trade, then you have to hold totally different types of analysis and trades. Okay,
Right.
so right now,
Okay.
go ahead.
Just that you had commented Monday mornings, it can be a lot of churn and chop as options adjustments are made. People have to, they have to settle their options, whether they're underwater or what have you. So a lot of this is related to that, I assume, in your
Well,
opinion.
it can be. It can be related to oil. It can be related to, to the junk bond market. A lot of volatility in this. A lot of volatility in this market. So right now, one of the things we said earlier, one of the most bearish trade today, in my opinion, what I wrote this weekend, would have been a rally that failed. It relieved and brought some of the balance, some of the short inventory from Friday back into balance. And but as we stand right now, we're still within Friday's range. This is a weak low again, okay? Because the day's low automatically, exactly matches Friday's low. It's a weak low. The odds of this holding are very poor. Okay, now we've changed time periods in there. We don't know how important the first half-hour volume is because we don't have a clear direction to it. But what I will say right now is even though we're bouncing, we changed time periods, we're bouncing, we're back above unchanged, but it is a weak low. Okay. Again, all I see in this market this morning, I see a lot of short-term trading. I see a lot of short-term trading. I see a lot of volatility. I do not sense any indication of longer-term money in this market. A
Right.
lot of chop. And remember, the Fed meeting starts tomorrow. They announce on Wednesday afternoon, and a lot of long-term money they just sit on the sidelines. But the short-term money can be very active in here. As you can see, there's been a lot of chop this morning. It had been very difficult to make money. A lot of traders probably have done numerous trades this morning, and my guess is they're either underwater or break even. It's just not a particularly good one to trade. But as we've ended the first hour, this is a weak low. Because it exactly matches Friday's low. The odds of this low holding throughout the day are greatly reduced.
Okay. Okay, great. As far as options, Jim, hold on. Though it's a weak low, but the volume had tapered with 90 cars, would you consider a long trade for a short-term scalp down there?
I would not. I would not. I mean, you've heard me say, well, I would consider a bounce. I would prefer to sell a bounce off for a short-term trade. I'd prefer to sell a bounce off of that weak low. I mean, that's what we talked about last week. That's what we talked about earlier this morning. But keep in mind, I have gotten pretty good over the years at just leaving my hands off of these kind of markets, because there will be, more than likely, there will be some good trades coming up today if you stay psychologically in tune with the market. For example, if you take a look to Friday, okay, what did we say on Friday? Go with all gaps that aren't filled. We also wrote that the best trade on Friday would be a failed rally. If you're an hour and a half, A, B, C, you're in the third half hour of trade, there is the best trade for Friday. There, it attempts to rally, and this is what we call an asymmetric opportunity. You know where to put your stop. If you get back up in this range, you want out of. If you're a short-term trader, you want out of that trade. So you had good potential on the downside, and you had a place to put your stop. Now, a lot of people couldn't do that because, oh my golly, I can't short with the market's down this much. Oh boy, I'd rather buy it than short it. But again, part of the market is to understand when you have a gap of this magnitude, and this is what I wrote the other day and I've written so often, the larger the gap, the lower the odds that gap will be filled. And the reason for that is the bigger the gaps, the more distortion that has taken place in the market. Being able to understand and internalize that concept will help you make some important trades. This was an important trade for day time frame traders on Friday. The market did rally. You're an hour and a half into the market, or someplace around an hour and a half into the market. It rallies, it gives you a place for a short, and it gives you a place for a stop based on structure. So it is a very, it's what we call an asymmetric opportunity. My guess is, if you keep your powder dry, there will be a similar opportunity today. Somebody asked, would I go long here? And I said, no, I'd rather wait and sell a bounce. But if you went long here, you're acknowledging that this is what the daytime frame traders are doing. And so therefore it's a legitimate, a lot of people have been taught to buy, particularly people that have been on floors, have been taught to buy all the previous day's lows and sell the previous day's high. And so that's a lot of what's going on. It also tells me that I don't have longer term money in the market. Longer term money does not wait till exactly the low. But my preferred trade is to sell a rally off of this with the idea that it'll come back through it. Doesn't have to. Okay, couple more questions. Are we pretty close to wrapping up?
Well, Jim, when you're talking about the 2008 reference, we're not having a problem with sound, I don't believe. Person asking. If anyone else is, let me know, but not as far as I know. I haven't heard people report that. Jim, as far as these references, you're using 2008. We had a couple of questions on March or D's contract. We're also being asked, on these monthly and weekly highs and lows, do you use the continuous contract rather than the front month, which you have to do when you're going back in time? But do you have any comments for him?
Yeah, I like to use the front month. I used to use CQG, and CQG was much easier for me to make sure that that's what I was looking at. TD Ameritrade doesn't have the same capabilities to it. We got away from CQG because our trading is more refined, is narrow to what we do these days, and CQG was just very expensive for what we do, and this works. But I prefer to look at the current month's highs and lows. But again, I can get a lot of that from the profiles. But it's a very legitimate question.
Okay, yes, thank you. Yeah, this settle, if you take it at the 4 o'clock New York cash close hour, it is the settle is a little different. We're still using the 4:15 futures runoff close. You'll have to watch both of them because there's, the CME's trying to shift that. Or I don't know if they're trying to shift it, but they made that announcement that it was 4 o'clock. What strikes did you buy on Friday, Jim, when before the
2050s.
close? Okay, thank you.
2050s. And now, let me go back to an options again. I mean, again, it's very hard as I'm doing this right now. But when we get off of this call, what I will do is I'm going to go and I'll put up an option screen, and I'll take a look at some short-term puts. And based on the fact that this low is a weak low. So right now it's going through my mind. It was a nice, somebody asked about buying. It's been a nice rally off of that. Been a very nice rally off of that. But, I'll look and see if this market starts to really, not show any continuation of the upside. I will be looking to potentially buy some puts. I don't know the strike price yet because I haven't gone over and looked at the screen. But this has got my attention. Right now you're getting more short covering. Incidentally, when you get short covering very often will also come from these exact references. Somebody that's short, you can just hear me say, oh my golly, give me one more chance. So again, from a daytime frame, somebody was right on the money. I said I wouldn't buy this. It was a good buy. I would be looking more to sell a rally that fails on that, coming back to this being a weak low. Okay.
And while we're on that too, Jim, we opened within balance and tested that prior pit low on Friday, but there were a lot of single prints in A period when B came in, to hold. We talked about that last week as well, that you don't tend to see that many single prints hold when you're in balance relative to the prior day, and we're seeing them fill in now. And as far as what put prices you'd ask, unfortunately, Jim's put option screen is on another computer, but we will be answering those options questions and being very specific, much more specific than these webinars when we're in the intensive. It's something all its own. So
I'm looking at this, and if I were to buy, I'm going to put the other screen up here in a second, but if I were to buy, I'd probably go look and say, okay, what are I'd probably start with looking at the 1990s puts. Okay. That puts them, 17 handles out of the money. I'll probably look at the 80s and 90s. I'm going to go over and I'm going to put them up on the screen right now.
Oh, you have them on this screen?
I have them on another screen,
yeah.
But I'm going to go look at the
1980s and 90s.
2090, did I get the right point? I'm sorry.
1980s and 90s.
1980s, I'm sorry. I should not be allowed with numbers. Okay, 1980 puts. Are currently, it looks like bid 1450. Offered at 1750, very wide spread, which goes with the volatility in here. But that's the kind of thing I will go and look and say, okay, do I want to play in that area or not? But again, I just go look at the screens, and I don't use the Greeks, but I look to say, is it reasonable that I'm going to be able to make a profit from that option, and I'd say, okay, how much would I have to drop to get down there? And then I will make it's a seat of the pants, a lot of seat of the pants type of thing. I'm looking at the volatility. One of the things I know is the higher the volatility, the greater the odds that the market's going to go to, if the market's weak, the greater the volatility, the higher the odds that it's going to go down and look at, if it starts to the downside, look at the overnight low. The lower the volatility, the lower the odds that I'm going to get enough meaningful movement to reach visible targets. High volatility. You're going to pay more for the options with high volatility, but it usually is money well spent. Because the higher volatility, the greater the odds that you're going to get to those targets. But again, there's not a lot of science. I'm looking at it, and I will look at for example, I'll look at the 80s, then I'll look at the 90s, and I'll look at the 70s, just to give me a little idea what might happen if this thing moved. So, for example, what price did I say what did I look at? Was it the 80s, Julia?
Yeah, you said 80s and 90s.
Okay, let me go back and let's see. When markets come down, the 80 puts at that time were bid, I forget what they were bid. Do you remember? Was it 1375?
I'm sorry, Jim, I'm doing too many things at once.
Anyhow, but the bid offers hasn't moved. Maybe it was 1475, 15 and a quarter. Not a lot of movement yet, but sometimes these aren't accurate. I have to be very careful. Okay, but again, you can see what I was talking about up here. I would be looking for a short because of this poor low, and not poor low, weak low, and I would very much been looking at options to do that trade. Well, you can see I missed that one in it, but you see what that actually is. It's a great example of what happened in here. We said this was a weak low. Somebody wanted to buy that low. That would have worked if you were quick. I said I'd rather look for a rally, and in my case, buying puts against it. That also would have worked. And again, so much of this depends on, if you're a short-term trader, how fast are you going to be? My preference was to, because of the weak low, my preference was to, position on a bounce. But either trade would have worked as long as you're pretty quick to understand that in this kind of volatility, you have to move quickly. I just looked over, and those 1980 calls are now showing 1775 bid, 18 and a quarter offered. And like I say, it may be better than that as this has gone down. So that
Where was the, excuse me, I'm sorry to interrupt. What was the original bid? Were we at 13? Has that?
I think it was 14. I think it was 1470. 1475 seems to be the price on there. I'm not sure if it's 13 or 14, but let's take the higher price, 14. But again, we didn't do it because it's hard for me to talk and do it, but I explained to you what I would have been doing. I would have taken this weak low, and it was a weak low again because it was exactly at Friday's close.
Friday's low.
Friday's low. I would have been looking on a bounce in order to buy my puts. So you saw the process and what would go through my mind at that point in time. But that's what I do a lot of times for short-term trading.
Right, and then people say, well, what strikes would he be looking at? And you, just to summarize here, what you did, you were looking at the overnight low, about 17 handles out of the money. You're looking at the charts and seeing where there's logical places, and you're also looking at the option premium, I imagine, too.
Yes, I am.
Because maybe the 80s are worth it to you rather than the 90s. But I'm just trying to address the questions.
Yeah, but that's not a big, look at the option premium. I do not look at the Greeks on there because.
No, I mean the price though, and how much they.
I was looking at the price, and I was just making when I look at this stuff, I said, do I have a reasonable chance to escape this trade if I'm wrong? If it does break it. If it doesn't break at all, it's going to hurt me. But if it does break, do I have a reasonable chance to escape if I don't get the downside follow through that I needed? And I can tell you, Julia's traded with me before. The way this market broke, had I bought the puts up here, the way this market broke, I would have taken action. Now, let's talk about what that action could be. Let's just pick a number. Let's say I bought 4 puts at 14.75, or call it 15. Now, when the market broke down there, one time we saw they were trading, 18, a little bit above. I have two choices when it trades down there. I can sell the options, or in a lot of cases, what I'll do is I'll go long futures. So if I'm short, I'm long 4 puts, I might have bought 2 futures against those. I would have done something when I'm doing short-term trades. Julia's traded with me enough, and see, either would have worked. Sold the puts or bought a couple futures against them. Okay, tremendous volatility in here this morning. As we said this morning, I don't know if crude did something. I'm talking, I don't know, did something go on? Was there any news or anything in the marketplace?
Someone had asked, I don't know if anyone knows if it's crude or what have you, please.
But this is the volatility. And as I said early on, when you got a day like today inside, boy, the volatility is going to be high. You got to be just very, very cautious. And again, this is why I use options. But this is almost an impossible day to trade. The options, the puts would have worked in there. You could have bought against them, or you could have sold them. But again, you get a day like this, it is not for the indecisive.
Right.
Okay, let me kind of cover, just do a little promotion here before we end up. Today is the first day for those that are members of the first intensive. The first intensive actually starts on January 19th. But starting today, we will issue a daily report and a morning report each day in order to give you some idea of how we are looking at this market. Then starting the 19th, we're doing live seminars. In most of the cases, that live seminar takes place early in the morning to get you oriented and started for the first part of the day. So we do the live seminar usually in the morning. If there's a big number coming out or a Fed meeting or something, we'll have one scheduled around the time of that also. But then throughout the day, we have a one-way chat. So I am doing one-way chats on the market. And the reason we do one-way chats is a lot of traders really, if you get the questions and answers going back on the chat, it gets very confusing for a lot of traders, and they're not interested in some of the questions. So it's a one-way chat. I'm putting posts out there that I think are relevant to what's going on in the market currently. Then you ask questions via email. And sometimes, depending on the magnitude of the questions, we can get to them right away. Really good questions that are pertinent to everybody. I will answer it on the chat so everybody gets a benefit to see the answer of that. And then at the end of the first intensive, for those that bought the continuation program, which is what most people have done, we continue to provide the reports between the period at the end of the first intensive and the start of the second intensive. And I will do a minimum of at least 2 chats a day, 2 posts a day, just in order to give you some continuity and to keep the market perspective. There'll be some caveats. There'll be occasionally a day that I have a doctor's appointment or I'm gone. But for the most portion, the continuous program, continuity program, is designed to be as close to you as we can for an extended period of time throughout here. But anyhow, let me thank you all very much for listening this morning and being here, and tell you we're just absolutely overblown by the number of participants that have entered into the continuity program, and all of it. But thank you all very much. And Julia, do you have any final questions there?
Well, we have a few just while you're on the intensive that I'm still going to have the Q&A session. So if Jim's on 9 to 11, we'll all be together for that. We take an hour break, and then I'll come back on twice a week with 12 o'clock to 1:30, 2 o'clock, whatever we need to answer questions, because we can't take we're going to really keep the beginner questions and intermediate as limited as possible so we can make the course as advanced as possible. And to accommodate traders that are coming up through the ranks, I will be on to answer those questions in 2 question and answer sessions after Jim is on in the morning. And of course, we're going to have the educational track and the options methodology. So we're going to have additional webinars for that. So it's going to be pretty power packed and quite different than prior intensives. Hard to say exactly how different because we haven't done it before, but we're doing our best to make it as robust and to meet what we said we would do. We've always honored what we said we'd do, so we plan to do that again. Did
And
I miss anything, Jim?
we will focus much more than we ever have in the past on the self-understanding type of thing.
Yes,
And a
the
lot of
third
it. And
new part. Yes.
yeah, we've got tremendous new information. I mean, Brett's book is just marvelous, as is Nonsense. Habit. There's some great books out there, and we're gonna suggest that those that are really serious do that work. One of the points that Brett makes in the recent book is, there's a difference between people's. Hold on. Did we lose me?
No, you're here.
Oh, okay. A lot of difference between people's desire to trade and their willingness to trade and their excitement about trading versus their commitment to do preparation. And everybody says, oh, I prepared. Preparing is not just putting out some numbers. Preparing is really writing down kind of what you see in the market. And what happens when in this preparation, a lot of people give it lip service, but it's important. When you start to write down what you think you see in the market, not abbreviated numbers, but really kind of an essay, a short paragraph, if that paragraph doesn't come easily to you, then you don't have the grasp on the market that you think you do. And that's one of the great reasons to write things out. So I don't need to write that down, I know. And all of a sudden you start to commit it to words and you say, wait a minute, you're not as comfortable as you thought. Well, you probably aren't as comfortable with what's going on as you should be. Remember, the combination is really between self-understanding and market understanding. Without self-understanding, and one of the things I wrote a letter to Brett over the weekend, and one of the things I was talking about is the importance of self-understanding. Without good self-understanding, it's very difficult to be able to view potential scenarios into the future. Good trading is about having a realistic imagination. A real imagination to say what can really happen in this market, both up, both downs. Without a good self-understanding, it's unlikely that you're going to have the clarity that you need in order to let your imagination expose you to what is really positive, what is really possible in the market. Anyhow, let me say thank you all very much. And Julia, unless you have an urgent question, I'll say thank you.
No, Jim, this is great. Thank you. You've done great, and we appreciate it. Everyone's saying thank you, and happy holidays to everyone out there too. Be safe, have fun. And also, I just want to mention, I mean, we're pretty much a community of traders in the intensive and at J. Dalton Trading. And someone told us, one of our Air Force, or maybe he's Navy pilots back from Iraq, that Todd, a guy, that's been in the intensives, his Red Baron team was inducted into the Aircraft or Pilot Hall of Fame. So congratulations to Todd. I don't even know if he's here. He usually says hi, so he must be flying. He's a commercial pilot and a stunt pilot on the side. But I'm pretty impressed with that. And, you pretty much know Todd if you saw our newsletter we sent out once, and you've been in the intensives. So very quickly, review, but congratulations to Todd, and everybody knows him, and that's really cool. I just wanted to give him some kudos. That's incredible. He's a wonderful guy. He's wonderful.
He's been very helpful to us because remember, here's somebody that could take one skill and project it to the ultimate thing and becoming a really tremendous stunt pilot. What he understood, the value he has added to us, and he's worked with a few of our traders. What is the value? He understands the process to becoming an expert in anything. It's not just wanting it. But he's been very helpful in that, and you can see that he's been rewarded in a couple of different endeavors. Anyhow, thank you all very, very much. And
Okay.
your lips are moving. You have a final
Yeah,
question?
I beg your pardon. I don't mean to interrupt. I'm pretty cranked up. We have a few questions on the offer. If you send us an email at jdaltontrading.com, I can talk with you about it. But basically, we got 2 intensives coming up. One the day after Martin Luther King Day, January 19th. The other April 4th. You can do both, save some money. You can do one. But if you do both, you get the reports in between. You're basically going to have coverage of the markets from today all the way through to May 9th, and we'll see where we go from there. But you're always welcome to call us or email us, and we'll get back with you. And Jim, great job. Thanks so much. Always great to hear you. And thank you, everyone, for hanging in there and for great questions and great participation. And we hope to see you all back next week. Same bat channel, Monday the 21st, 9 a.m. Eastern. That'll be our last webinar for this year. We'll take the week between Christmas and New Year's off, and we'll be back with more webinars in January. Okay, so thank you, everyone. Really great to have you here. We appreciate your time very much. And thank you, Jim. Very much appreciate it.
Thanks, Julia. Thanks, everyone. Bye now.
Okay, great. Bye-bye.